As of the market close on Friday, May 22, 2026 at 4 p.m. Eastern Time, Lucid Group Inc., trading under the Nasdaq ticker LCID, finished the regular session at exactly $5.84 per share, showing no net percentage change for the day after fluctuating within an intraday range of $5.82 to $6.07 on a total trading volume of over 10.7 million shares. The underlying friction in this flat finish, however, reveals something far more complex than a stock just resting in place. While casual market observers look at a flat line and assume nothing is happening, institutional players are quietly positioning themselves around a massive structural shift that completely changes the math for this company. The immediate instinct for many retail investors looking at online investing sites is to view this luxury electric vehicle maker as a distressed asset that requires ongoing lifelines to keep its manufacturing plants running. But the actual reality unfolding right now points to a completely different corporate destiny. Lucid is fast morphing from a standard luxury car producer into a sovereign-backed infrastructure layer for autonomous transportation. The typical expectation surrounding Lucid stock is rooted in the visible struggles of the consumer electric vehicle market. High interest rates, infrastructure fatigue, and a general cooling of consumer enthusiasm for high-end luxury electric sedans have left many assuming that smaller, pure-play luxury brands are simply running out of runway. When you search for investment help or browse options on popular individual brokerage platforms like Robinhood or SoFi Invest, the consensus narrative suggests that legacy automakers and dominant players will inevitably crush specialized luxury startups. This common belief keeps a massive short interest glued to the stock, with nearly half of the available float shorted by traders betting on an eventual operational collapse. However, the contrarian reality is that Lucid's technological core is being aggressively capitalized by entities that do not care about next quarter's retail car delivery metrics. The massive structural commitments made in mid-April of this year, specifically the expanded partnership with Uber to supply at least 35,000 vehicles for a global robotaxi network, alongside a simultaneous capital injection from Saudi Arabia's public investment fund, demonstrate that the company is being deliberately insulated from the retail consumer slowdown. The market is pricing Lucid as if it is failing to sell cars to wealthy individuals, while the reality is that its powertrain efficiency is being bought out to underpin the massive fleet-wide transitions of corporate autonomous mobility. When analyzing the recent stock movement, the daily swings tell a story of an intense tug-of-war between aggressive retail short sellers and steady institutional accumulation. Trading volumes have spiked around key technical levels, particularly as the price hovers just above its 52-week low of $5.55, far removed from its multi-month highs near $33.70. This massive contraction in valuation has fundamentally changed who holds the shares. Institutional activity shows that while traditional asset managers using standard investing sites might be trimming exposure to speculative automotive manufacturers, specialized entities and sovereign wealth funds are soaking up the float. This became glaringly apparent during the early May earnings reaction. Lucid reported first-quarter revenue of $282.5 million, which represented a 20% increase from the prior year period, driven by a 149% surge in overall production to 5,500 vehicles. Yet the stock experienced intense downward volatility because actual physical deliveries came in lower than expected at 3,093 units, caused by a sudden component supplier issue that temporarily choked the shipments of their highly anticipated Gravity SUV model. The regular media immediately highlighted the suspension of the full-year delivery forecast as a catastrophic sign of structural decay, triggering panic selling among individual brokerage accounts on platforms like Interactive Brokers and Robinhood stack trading apps. But what the crowd missed was the massive post-raise liquidity cushion, which surged to roughly $4.7 billion. The company is losing money on every vehicle built, yes, but its financial runway has been systematically extended, creating an environment where short sellers are trapped in an incredibly crowded trade against a backstop of virtually unlimited capital. Macroeconomic pressures are undeniably dictating the short-term trading patterns of the stock. High sustained interest rates have made financing a luxury vehicle an expensive proposition for the average consumer, impacting the broader luxury automotive sector. When investors evaluate alternative allocations across Fidelity investments, looking into Fidelity ETFs or Fidelity mutual funds for stable returns, speculative tech-heavy automotive plays like Lucid are often the first to face liquidation pressure. Sector momentum has heavily favored established profit-generating technology firms, meaning capital has been actively pulled out from pre-profit industrial companies. This has created a persistent technical drag on the share price. The daily volume patterns show an algorithmic capping of any upward momentum. Every time the stock attempts to mount a sustainable rally, automated institutional programs and short positions re-emerge to suppress the break, as seen during the intraday push towards $6.07 before the price was pushed back to settle at $5.84. This indicates that while the absolute downside is heavily protected by the sovereign capital floor, the upside remains restricted by the reality of ongoing cash burn and the structural dilution from regular equity offerings, such as the $1 billion public offering executed alongside the Uber agreement. Let us look deeper into what this business actually does, and how its core operational model functions away from the daily noise of the trading screen. Lucid Group operates as an integrated automotive and technology firm that designs, develops, and builds luxury electric vehicles entirely from the ground up, while also engineering advanced powertrain and battery systems in-house. Its primary manufacturing hub is a highly advanced purpose-built facility located in Casa Grande, Arizona. Unlike legacy car manufacturers that assemble parts sourced entirely from third-party global suppliers, Lucid's primary competitive advantage is its extreme vertical integration. The company engineers its own electric motors, microinverters, and battery packs in-house, achieving a level of energy efficiency that leads the entire transportation market. This proprietary powertrain technology is so advanced that outside luxury brands including Aston Martin have actively signed multi-million-dollar agreements to purchase and integrate Lucid's drive units into their own upcoming fleets. The business model relies on leveraging this technological superiority across multiple vehicular segments, starting with the ultra-luxury Air sedan family, moving into the premium utility segment with the Gravity SUV, and eventually scaling down into higher-volume midsize platforms. Looking back at older historical reports, the company originally entered the public markets via a massive reverse merger with a special-purpose acquisition company valued at over $11 billion, which injected immense initial capital, but also set sky-high market expectations that the company spent years trying to meet amid severe global supply chain disruptions. To really understand why the current valuation is so heavily contested, one must look closely at the underlying financial statements and past operational performance. For the full year 2024, the company generated $808 million in total revenue, while delivering 9,029 vehicles globally. However, the industrial scale required to achieve profitability in automotive manufacturing is immensely capital-intensive, resulting in an operating loss of over $3 billion for that same period. This massive gap between top-line revenue and industrial cash burn is exactly what scares traditional value investors who utilize platforms like Schwab Intelligent Portfolios or conservative Fidelity brokerage accounts. When a self-investing individual opens a modern Robinhood app or checks their SoFi Active Investing dashboard, seeing a net loss that mirrors or exceeds total revenue naturally flashes a red warning light. But the underlying narrative is shifting from a standard retail product rollout to a technology licensing and fleet operations play. The critical asset is not just the physical car, it is the autonomy-ready architecture built directly into the vehicle platform. The software and hardware systems are specifically designed to support advanced driver assistance features and eventually complete driverless operations, which is precisely why corporate logistics and global transportation networks are stepping in to secure production capacity. Comment below how many shares of Lucid stock you currently hold, or if you are choosing to avoid the pure EV sector entirely in this current market environment. Your input on this helps gauge where retail sentiment is hiding versus where institutional capital is moving. Looking ahead toward the future outlook, the trajectory of this stock will be entirely determined by the resolution of the tension between immediate industrial execution and long-term infrastructure implementation. There are two distinct, highly plausible scenarios that could unfold over the next 12 to 24 months. In the first scenario, the company successfully resolves its near-term component bottlenecks, allowing the Gravity SUV production to scale smoothly throughout the remainder of 2026 and into 2027. If the Gravity can secure a dominant share of the luxury electric SUV market, the resulting cash flow will begin to narrow the operational losses, providing a clear path towards gross margin positivity. Simultaneously, if the initial deployment of the 35,000 vehicle commitment to Uber's future autonomous network rolls out efficiently, it will validate Lucid as the primary hardware supplier for the global robotaxi infrastructure. This would force a massive wave of short covering, as the 48% short interest is forced to buy back shares into a rising market, creating a structural squeeze that could rapidly re-rate the stock toward historical valuation levels. Conversely, the alternative scenario presents significant operational hazards that investors must carefully weigh. If global supply chains remain volatile, and the company faces further delays in its mid-size vehicle platform development, the current $4.7 billion liquidity cushion will inevitably deplete over the next 2 years. Because the major shareholder, Saudi Arabia's public investment fund, holds a controlling interest, any subsequent emergency funding rounds will likely involve further common stock issuance or convertible preferred equity structures. For an individual utilizing an individual brokerage account or managing an intelligent portfolio on mainstream investing sites, this means persistent share dilution is a very real risk, effectively placing a structural ceiling on how much earnings per share can recover even if total revenue expands significantly. Furthermore, if consumer demand for premium electric vehicles continues to stagnate globally, the company will remain entirely dependent on corporate fleet contracts and sovereign lifelines, turning it into a semi-private entity disguised as a publicly traded stock. When you step back and view the entire landscape, the central insight regarding Lucid Group is that the market is evaluating it through an outdated framework. The broad public expectation is that this is a traditional luxury car company struggling to survive a challenging retail consumer environment, visible every time you look at the flat intraday charts on a Fidelity mobile app or an interactive broker's platform. The reality, however, is that companies' advanced powertrain technology and massive cash reserves have effectively transformed it into a long-term option on the future of commercial autonomous mobility. The downside is fundamentally anchored by sovereign wealth, while the upside is entirely tied to whether their engineering can become the standard operating system for global fleet networks.
It is a classic confrontation between a highly visible, near-term operational struggle and a hidden, long-term structural alignment. For investors navigating the modern digital landscape, success in tracking this asset requires ignoring the superficial daily noise and focusing entirely on whether the reality of their industrial scaling can catch up to the massive capital expectations set by their institutional backers.